All right, let's just dive right into this explainer. Today, we're officially crossing the threshold into Phase 5 of the crypto trader journey, and we're tackling the absolute beast of a syllabus that is Day 26, Mastering Backtesting.
We're basically stepping into the laboratory today, guys. Phase 5, it's a completely different animal. The training wheels are officially coming off. This is where you stop guessing, stop hoping, and start treating your trading like a rigorous, cold, hard science experiment. A true professional workflow doesn't rely on gut feelings or, some late-night inspiration or whatever the latest crypto guru said on social media. It relies on a systematic, repeatable process. Just like a scientist would never dream of publishing a paper without testing their hypothesis in a totally controlled environment, a pro trader doesn't put actual capital at risk without running their strategy through the absolute gauntlet of the lab first.
So Day 26 marks this critical evolution in the curriculum. Look, amateurs might glance at a chart, spot a pattern they kind of recognize, and just smash the buy button. We've all been there, right? But making that leap to becoming a professional, that requires a complete, ground-up mindset shift. It takes intense discipline, strict adherence to a plan, and most importantly, empirical evidence that your plan actually, works. That shift from guessing to knowing is exactly what today's module is designed to trigger.
To actually pull off that shift, we need to master the overarching concept of this entire module, which is backtesting. Simply put, this is the process of testing a trading strategy on prior time periods. It's the ultimate proving ground for literally any idea you want to bring to the live market. Honestly, think of it like a time machine. You're taking a specific set of rules you built today, traveling back in time and asking, okay, if I had traded exactly this way over the last year, or say, the last 5 years, what would have happened? The best part? It lets you completely simulate your strategy's performance without risking a single solitary dime of your actual capital.
But obviously, to run that time machine, you need fuel. The very first raw material you need in our little lab is historical data, which serves as the concrete control group for your experiment. I mean, you can't test a strategy on past time periods if you don't have a perfectly accurate record of those periods, right? This data includes past market prices, your opens, highs, lows, and closes, as well as the trading volumes. It represents exactly what went down in the market, minute by minute, day by day. And listen, your historical data absolutely must be clean and precise, because in data science, there's that golden rule: garbage in, garbage out. If your control group is flawed, the whole experiment is basically toast.
Notice the chronological sequence we're setting up here. You don't just randomly throw ideas at the wall. There's a super strict order of operations. Step 1 is gathering that historical data to lock down your timeline. Only then do you move on to Step 2, which introduces the next major requirement from the syllabus: applying your entry and exit rules. You have to build the environment first, and then you inject your variables into it.
Let's look a bit closer at those variables. The real secret sauce here is strictness. You apply your entry and exit rules over that data to dictate exactly when to buy and sell. In a true professional backtest, there is absolutely zero room for ambiguity. None. Zero room for emotion either. You can't have a rule that says, buy when the market looks good. Actually, scratch that. A computer doesn't even know what looks good means. Your rules must be totally mathematical and absolute. For example, buy when the 50-day moving average crosses above the 200-day moving average. It either happened or it didn't. Boom. Simple.
Now, in a perfect world, a backtest would just calculate your ideal entries and exits and hand you a giant oversized check. But the curriculum immediately snaps us right back to reality. To build a genuinely professional workflow, your backtest has to incorporate the messy friction of the real world, specifically transaction fees and slippage. Because, let's be real, if you only test your rules in a vacuum, you're just testing a fantasy.
So, what does that friction look like? Well, every single time your entry or exit rules trigger a buy or a sell, the exchange is taking a cut. Always. It might seem like pennies on a single trade, but if your strategy is executing hundreds or even thousands of trades over a year of historical data, man, those transaction fees compound massively. A strategy that looks like a wildly profitable gold mine in a perfect world simulation can actually turn into a devastating loser once those exchange fees take their pound of flesh.
Alongside those fees, you absolutely have to account for slippage. This is kind of like an invisible ghost that strikes when prices move super fast between when you place your order and when it actually executes. In your backtest, your rule might say buy at exactly $10,000, but out in the wild, the real professional world, by the time your order actually hits the exchange, the market might have spiked and you actually get filled at $10,010. That $10 difference? That's slippage. If your backtest assumes you just always get the exact perfect price you want, it is straight up lying to you. A true professional workflow mathematically simulates the slippage to really stress test how robust the strategy is. Okay, so once you have your historical data, your strict rules, and all those real-world costs fully accounted for, your backtest is going to spit out a massive list of trades. But a giant spreadsheet of trades isn't really helpful on its own, is it? Now it's time to actually grade the experiment using 3 very specific mathematical metrics. The syllabus mandates we tackle win rate first. This simply tells us the frequency at which your strategy succeeds. It's probably the most straightforward metric out there. Out of every single trade your backtest executed, what absolute percentage actually made you money? So you took 100 trades, 60 were profitable, boom, you've got a 60% win rate. And while beginners often obsess over having this incredibly, unrealistically high win rate, the pros know it's really just one piece of the puzzle. Still, it gives you a really vital baseline understanding of how often you actually get to experience the psychological boost of a winning trade.
Visualizing those wins stacked directly against your losses leaves you absolutely nowhere to hide. The data is 100% objective. It reinforces a pretty harsh truth we all have to accept. Losing trades are an absolute certainty. There is no magic strategy with a 100% win rate out there. The goal of the professional workflow isn't to magically eliminate the losing slice of your history entirely. It's to ensure the winning slice mathematically outpaces it over the long haul.
Which brings us perfectly to the next metric, and arguably the most important one, the profit factor. This is crucial because it measures the actual size of your wins relative to your losses. Think about it like this. You could have a crazy 90% win rate, right? But if you're only making $1 single on every winning trade and then losing $100 on every losing trade, your account is still going to hit zero eventually. The profit factor solves this. It takes the gross profit from all your winning trades and divides it by the gross loss of all your losing trades. It answers the one question that really matters. For every dollar I lose, how many dollars do I make?
Let's throw out a concrete target for some perspective. A profit factor of 2.5. This means your strategy is making significantly more money than it's bleeding during those inevitable losing streaks. For every $100 you lose, you're generating $250 in your winning trades. Seeing a number like that pop out in your backtest results, especially after you've already factored in historical data, transaction fees, and slippage, that is a massive, flashing green indicator that you've got a robust, professionally viable strategy on your hands.
But hey, before we pop the champagne over that awesome profit factor, we have one final, very sobering metric to confront: maximum drawdown. This is a genuinely terrifying but utterly essential metric. It measures the absolute deepest continuous loss your account would have suffered. Like, sure, a backtest might end up incredibly profitable after a 5-year run, but what on earth happened in the middle? Maximum drawdown looks at your portfolio's highest peak and then measures the steepest drop down to the lowest trough before a new high is ever made. It's basically calculating the absolute worst losing streak your strategy endured during the entire testing period. Charting that massive peak to trough drop really helps you understand if your psychology can actually survive your strategy's worst-case scenario. Because going from that high peak all the way down into the trough, it is agonizing. If your backtest shows a max drawdown of, say, 40%, you really have to look in the mirror and ask yourself a hard question. If I'm trading this live and my account loses 40% of its value over 3 agonizing months, am I going to have the professional discipline to actually stick to my rules? Or are you going to panic, pull the plug on the strategy, and lock in that massive loss right at the absolute bottom of the trough? Maximum drawdown is the ultimate test of your mental endurance.
So, having absorbed all these crucial building blocks, the data, the strict rules, the market friction, and those grading rubrics, you are finally ready for Phase 5's capstone project. Everything we literally just covered directly feeds into this next action. The official project mandate gives us one very clear directive. You must backtest one clearly defined strategy, just one, not 2, not 10, but it absolutely must be clearly defined. That means utilizing every single rigorous workflow element we've discussed today. You've got to gather your historical data, you have to codify those entry and exit rules so they are ironclad and absolute, you must deduct your transaction fees and estimate your slippage, and finally, you have to produce a report showing your win rate, your profit factor, and your max drawdown. This is it. This is the exact moment you take all this theory and put it to work in the laboratory.
The market is completely unforgiving, and this curriculum is explicitly designed to make you just as ruthless in your preparation. So, as you head into the lab with your data, your strict rules, and all that market friction in hand, you've got to ask yourself, When you finally strip away all the emotion, all the hype, and apply the cold, hard mathematics, will your strategy actually survive the test, or will the market just eat you alive? Dive into the data, run those numbers, and let the backtest reveal the truth. Good luck in the